Hello, everybody, and welcome to this week's Investor Insights. And our guest is Kyle Asman from Backswing Ventures. I'm Bonnie Halper. I write the weekly Startup One-Stop newsletter. I'll put the link in the chat. And I also work with entrepreneurs, helping them with their pitch decks, because none of you know how to do it properly, and I know that Kyle can attest to that one. And with their talking points before they meet with investors. And what else? And like we host these every 2 weeks online with a different investor each time, and a self-selecting group of entrepreneurs. And I want to thank Joseph for hosting us every week. Joseph, you want to tell us a little bit about yourself and what you do?
Sure thing, Bonnie. Good morning. Good morning, everyone. Thanks for joining us. Good to see a lot of familiar faces. My name is Joseph Katz. I've, for the last dozen plus years, been helping early stage companies go from unknown to well-known, putting together go-to-market strategies, marketing plans, and programs that help them grow and get larger and more valuable. So if anyone needs help with that kind of work, I am available to chat. Good to see everyone and excited for today's conversation.
Yes. So Kyle, as I said, Kyle Asman is our guest investor this week. And do you want to, we'll start by going around the room and have everybody very briefly introduce themselves, because we have a big room and probably more to come. I'll just go down the list. David. Lit hour, just in case we have more than one David. David, you want to introduce yourself?
So sorry, I was on something else.
Okay.
I'm David in New York. I work for Renegade Marketing, a market research firm. And thank you, Joseph, for giving me the link to join this every other week chat. Thank you.
Oh, thank you. Daniel.
Good morning. My name is Daniel Villau. I'm CEO of Intelligent Partnerships. We're a compliance design and delivery firm and have developed a digital platform for the purposes of moving compliance from post-performance review into real-time analysis.
Jonathan.
My name is John Landers. I'm Chief Marketing Officer for iGuard Home Solutions. We make a product that prevents kitchen fires so that people can age in place, or those with special needs or veterans, from having the most common cause of fires, which is or forgotten cooking in the kitchen. And I'm over in Tampa, Florida, Kyle, so I got whacked by the storm last time that you just had rain and wind with.
Well, hopefully we made it through it okay.
Yes, yeah, did. And thank you, Joseph.
Yusuf. Yusuf, did you want to introduce yourself?
You're muted.
No. Oh, I don't see it being muted.
Is it better now?
Yes.
Yep. Oh, sorry about that. Thank you, Bonnie and Joseph again for organizing the event. So a bit about me. I work in product management. I actually moved to Canada a couple of weeks back. So right now I am in between jobs. I'm looking for new opportunities. I am a startup guy. If you may have been through, I've worked in startups all of my life, and right now just here to check things out, preferably, possibly, get to know everyone here, and yeah, expand my network, I suppose.
Oh, you should put your contact information in the chat or your LinkedIn. Andrea.
We'll do that. Thank you.
Sure. Oh, Andrea, you're muted. Sometimes she's traveling, so she can't. I'll come back to her later. Bill. Bill Owens.
Bill's muted too. Bill's one of my investors. I sent the link to some of them and they joined the chat.
Oh. Are we having technical difficulties? We'll move on to Chris Reynolds for now. Oh, who's muted? You're muted, Chris.
My apologies. I was working on something else. Chris Reynolds, I'm with RCB Frontline, an early stage venture capital company.
Oh, okay. What do you do there?
I'm a venture partner. I'm in charge of fundraising primarily, and then account management of the portfolio companies that we have and investor relations. And we're
Okay.
focused on food and beverage specifically and food technology.
Oh, we should talk. I already did David. Oh, Andrea. Oh, that's right. Dean. I know Dean's not shy. He's muted, but not shy.
Okay, I think I'm unmuted now. I'm Dean Margolis, the founder and CEO of Red Sky Health. We're using artificial intelligence to fix health insurance denials for group practices and small hospitals. That's what we're up to. Less than a year old. We've gotten some good traction and we're off and running.
Yes. Deborah.
Hi, everyone. Deborah Lee from Pittsburgh, Pennsylvania, managing director for Debonair Consulting with Bonnie and then DM Lee Enterprises. So I work primarily with all stages of startups with Bonnie, and we help them with preparing for capital raise and then also with the capital raise themselves.
Paul Ballas.
Hi, everybody. My name is Paul Ballas. I'm based in New York City. I'm a product manager working for a big data provider within grocery called Spins. Before that, I was a startup co-founder. Before that, I worked in healthcare investment banking. I'm just learning a little bit more about the venture capital space. I started one of those Venture Scout programs, so I'm a new Venture Scout. And so, yeah, happy to be here.
Marcelo. Okay, Scott Purdy. I know that Scott's not shy.
I am not shy. But of course, somebody called me right at the moment that you called on me, but I am not shy. My name's Scott Purdy with a company called Cine, based in South Jersey. We're really a Philadelphia area company. We've been in this for a little while, but we recently had a reorganization, a new CEO, and we're on our way. We've been mostly self-funding up till this point. Our product is just about ready to go. Our product is a filmmaking app. Just in short, it allows you to have multiple inputs from any place in the world, and in a few seconds have a completed professional movie or video or film or whatever you want to do with it. We're in a part now where we're looking for angel investors or maybe first range so that we can get the programming done. I mean, we've been doing a really heck of a job with the group we have, but in order to utilize the AI that we want to incorporate into it, we need to pay the programmers. So that's what we're looking at right now. There's some funding so we can pay the programmers and then have a final fully working product above the MVP.
Okay.
And I've been coming for a while, but then I took a little hiatus there, and I just recently came back again, and I plan on attending just about every one if I can.
Oh, cool. And you're always welcome. Ian.
Hi, everybody. Good morning. Ian Garmaze. I'm in Toronto, and I'm the COO of Virtual Film School based in Hollywood. We are an online film school. And I'll post my contact info. Anybody who wants more info, I'm happy to provide it.
Zarin, welcome back. Always good to see you.
Thank you. I'm Zarin. I'm based in Switzerland. I have banking background, and currently I work with a few companies on business development and strategic partnerships, mainly in the areas of asset management and e-commerce.
Thank you. Ken Deering.
Good morning, early morning here from Seattle. I work with John Landers, and as John said, we cover off two areas, age tech, for if you can't safely cook, you lose your independence. So that's our go-to-market for our first product. We sold over 5,000 of them. And the exciting part for us is we're pre-seed, and our second generation product's also an InsurTech product, because the #1 cause of normal house fires is also forgotten cooking. So we kind of straddle two different market areas with our second generation product. And it's first time here. And thank you to Joseph. He reached out to us about 5 days ago. We had a great conversation a couple of days ago, and that's where we learned about this event.
I'm one of those people I'm always multitasking and always cooking. So I have time. I have 4 timers. I need them. I hope I got everybody. If I forgot you, please introduce yourself, or if you couldn't speak before, we're muted. Otherwise, Kyle, take it away. Tell us about yourself.
Yeah.
About the fun. Oh, did I miss somebody?
No, I think anybody had their hand up? No, awesome. Well, thank you again for having me. I think the last time I spoke in this breakfast was 2021, and as Bonnie pointed out, I was living in North Carolina. So I'm the managing partner of Backswing Ventures. We are a seed stage venture fund. We actually just launched our second fund in February of 2023. I launched the first fund in February of 2020. First time fund, simple thesis, we were looking to invest in companies with $1 million in revenue, valuations under 20 million, that we're going to be profitable in 18 months of investment. I launched the fund literally February. We took my first dollars on February 24th, 2020. So it was a really interesting time to have launched an absolutely brand new venture fund right at the doorstep of COVID. Venture got an unexpected boom during COVID because there was so much money put into the economy by the government that valuations just went crazy. I mean, we had companies raised 2 and 3 times within an 18-month period, which is kind of unheard of in the seed stage. I mean, there was companies we invested in March of 2020 that were doing Series A rounds by September. So it was just this crazy boom in venture. We got all these really weird looks when we asked people about their revenue and profitability, because at that point in time, all anyone ever really cared about was growth. So we invested in 10 companies in that fund. One of them is a company called Zero Eyes that does AI gun detection. It's a software program, and they're about to reach unicorn status. We invested in that at a $6 million valuation, and we returned 40% of our LP capital in June of last year on that partial secondary sale on that investment. So we were able to return some capital pretty quick, and we've been doing really, really well with the first fund. So we launched the second fund. So fast forward kind of 2-3 years, and now I get on calls with people, and before I even say anything, they're talking to us about, hey, we're going to be profitable in X amount of time. We have X amount of revenue, because the market has totally changed. Does anybody here who's in the venture marketplace has probably noticed companies that, in the seed stage that used to be all growth focused, even at really every level. And now it's all about profitability and getting to being a cash flow positive operating business. So fund 2 is a $15 to $20 million fund. We've raised 15, we may go to 20. We've deployed into a couple of deals so far. We actually had an opportunity to reinvest in Zero Eyes, which we did. We invested in a company called VATN Systems that does underwater autonomous vehicles for surveillance and kinetic purposes. So they've been doing really, really well. They're working on a contract in Ukraine currently to deploy their system to help the fight. And then the third company we've invested in is a company called OpenEye Analytics. So they are an OSINT data provider. So basically they aggregate massive amounts of data from all of these partners that they've developed and all these different data providing companies, and they use mobile ad IDs and cell phones to identify where people are. The technology I've learned about is scary. I'll give you an example. So every device, when you go to a store and buy it, has a mobile ad ID in it. Every iPhone, every iPad, every computer, there's a chip in there. It's registered to you when you purchase it. So they can go back and access cell tower data for up to 2 years and see anything you've done on your phone in the last 2 years, any apps, any emails, any texts. I saw Bonnie's newsletter this week talking a little bit about Big Brother, and they can see all that data. So one of their use cases is in Ukraine. The CEO just got back from Ukraine. They want to use it as a targeting solution. So they're trying to attack Russian troop congregations at different points in Ukraine. So they access one of the cell towers. They put up a geofence. They know the cell numbers of the Russian soldiers, and they can track those devices and see where they are. Another use case right here in the US, they're in talks with Disney to use the product to create a geofence around Disney. So they'll load all the sex offender cell phone numbers into a database, and they'll create this geofence around Disney. So anytime a cell phone registered to a sex offender crosses onto Disney property, they're not allowed to be that close to children. Disney security or Orange County sheriffs can go grab those people, prior to them being able to do any harm. So it's got some cool uses that we're really excited about. But having conversations with them and some of their data providers, it really is scary to see how much of your data is out there and how easily accessible it is. So we have a couple other companies we're in talks with right now about investment. Those are our 3 deals so far. We'll probably do another 2 to 3 deals in the next 90 days. And we've been very active because of the success we had with Zero Eyes and a lot of the relationships we developed. We actually focused this fund on the defense software and hardware space. We won't only look at that, but that is really our focus. We'll look at other deals that meet the financial criteria, but that's kind of what we're focused on. Again, as far as the venture market, we've kind of noticed that there's been a pretty significant decline in funding, especially at the later stages. The earlier stage, there seems to be quite a bit of capital getting into deals that right now, but the later stage has been choked out. And that's been due to raising interest rates, in my opinion. These companies used to get bought by major corporates, and they would finance the deals mostly with debts. These billion-dollar companies, $800, $500 million companies, no one was paying cash for them. It was all debt finance. And now debt's gotten so expensive that these companies can't afford the acquisitions anymore. So these venture funds are stuck pouring money into these companies kind of to keep them afloat because they're not break even, and they can't get any money back to LPs. They can't raise money. So it kind of chokes out the entire cycle at the later stage. But the earlier stages has generally been unaffected to a greater degree so far, because there's so many companies and so many funds out there who still want to invest in the early stages of innovation, and they're starting to see that as the right point to get into these companies. So that's kind of what I see going on right now. That's a little bit about me and my fund, and I'm happy to answer any questions, talk through any questions anybody has about venture, the economy, markets, our portfolio, what we're doing, etc.
Do you have a specific focus? Because
security technology, hardware and software. I'm not a technology expert. That's actually why we do the revenue thing, is I use the revenue to de-risk products. So I can't go and look at a software or hardware and say, hey, this is great, this works. I go see demos and I ask to speak to clients. So I want to see the revenue because that helps me de-risk the product. I want to see, hey, if a customer is willing to pay for this product, they're willing to use this product. Well, that makes me a whole lot more comfortable about investing in it without having to spend thousands of dollars going through tech reviews to see if the product actually works.
Thank you. So what size checks do you generally write?
So we've been doing $500,000 initial investments, and then we reserve significant room for follow-on. That's been our standard across all the deals we've done so far. So the idea model is we'll usually invest sub $10 million valuation. A lot of them are closer to 5. So if we put $500K in, we'll own 10% of the business, and then we'll follow on probably 1 to 2 more times. We'll follow on with another $500K, and we might follow on with another $500K in a later round after that. It gives the later investors confidence that the early stage investors are still following on, and allows us to double down on the winners.
Thank you. So questions? Anybody?
Sure, if you don't mind. So what about early stage companies that, they have revenue? I'll just use ourselves as an example. Obviously, we have revenue, we have a proof of concept, we bootstrapped all the way to a market ready product, which we're ready to go with, but we don't have users yet because we're about to go into beta. And so, what's your thinking about reviewing companies like that?
Yeah, so we won't invest in a company for user base, just because we want to see that user feedback to make sure they like the product. Because if they don't, and then we invest, it can kind of become a bottomless pit for us. But there's a lot of pre-seed funds and angel funds that invest exactly at that stage. There's Darling Ventures, is a Florida-based fund that I work closely with, and they invest specifically at that pre-seed stage. So they'll invest in a company that's pre-product all day long. That's their model. And they love doing that. They feel like they get into best valuations and they can help mold and grow the company. So there are people who do that. I just don't do anything that doesn't have revenue. I want things after our investment to be able to sustain themselves. So if these companies didn't raise another dollar, they would be able to survive on their own cash flows.
We can do that, but happy to chat.
I do have a question.
Sure.
Sure.
This is John Landers, just over from Kyle in Tampa. And the question is we've been doing our due diligence and get ready to talk to people about our seed round and have been talking with angels, the big pushback. So it was very encouraging to hear what you said, that you are investing in both software and hardware, because we've run into a lot of pushback by the fact that we are hardware in terms of our technology solution. Now, once you have it in, it relies on software to give updates on the wellness of people in their home. But I'm wondering what you've heard in the marketplace about this resistance to investing in companies that are both hardware or software.
Yeah, I think most of the, I don't know many people who dislike software, because software, once you have a software product up and running, the margins are great. It's usually recurring revenue. It's easy to model out. Most venture funds love software products, unless you're in consumer product goods or you're specifically hardware focused. People love software. I think a lot of people's problems with hardware come in where they think that hardware constantly gets innovated and constantly gets outdated. And when you look at a company like BlackBerry or what Apple did to the cell phone space, all those people who had warehouse and manufacturing operations that are building those cell phones are instantly out of business overnight. And I feel a lot of people feel that way about hardware, is that hardware is just so expensive to develop. And it's so expensive to keep up with the changes in technology. You're constantly innovating the product, that the CapEx to keep your product up to par scares a lot of people off on the hardware side. So I think that's why people do it. But I think that for the most part, especially in the defense space, hardware and software, if you can do both, it's fantastic, because then you can control your business, right? You don't have to rely on another supplier. You don't have to wait on supply chain lags. If you can do hardware and software, and you can keep your software cutting edge and your hardware cutting edge, you're going to have an advantage to the market, because you're not reliant on somebody else to provide your solution.
That's great. Thank you. That's good insights. I appreciate it.
I had a question for Kyle. You had mentioned about user-based. One of the things that we want to do with our product is eventually have a ton of users. You don't want to be able to have people for free go on and go ahead and use it and create these videos and films. And we think there's a specific market in a social aspect. So it will be like a social network for people interested in making movies, making films. Currently, it's been being used to make on Magnet Magazine a lot of videos. So, but you had mentioned about the users in the past, it was like people would want to know, like, how many users do you have? So is that analysis shifting a little bit more? Because we can't go on and say we have 100,000 users, because the working product, the way we want it to work, is not out there for people to use yet. But yet we still want to look for funding so that we can get to that point.
Yeah, so I have one portfolio company, actually two. One's in ed tech and one's in beauty tech, that have physical user bases that they're B2C. So they have user bases. I know one of their major investors was really focused on their total user count. I was more focused during that process on how much revenue they're generating per user, because like you said, you could have 1 billion users, but if you don't make any money on any of them, you'll have the same problem Twitter's having right now, right? I don't know what Twitter's user base is, but they're losing money. They're not, the business is not viable until they get to break even. Somebody's not going to, Musk might fund it forever, but somebody can't fund it forever is the point. So I look at revenue per user. I think that's a focus that people are looking at more, is like user acquisition costs and revenue per user. I think if you look at, even like Disney Plus or Disney reported earnings yesterday, they talk about their user count. I think that top line number, but the analysts really dug in deeper on what are you paying to acquire them, and what's your actual, how much revenue are you generating per user, because they have a bunch of different tiers of pricing. So those metrics are more important to me. So the other company, the one in the ed tech space, their investors, their larger investors, Series A, Series B up the chain, have really been focused on those metrics, is how much more money are you generating, because there is an ed tech, so they'll go sign up, let's say, use an example and say Notre Dame. I think that actually might be one of their schools, but I mean, Notre Dame has what? I don't know how many they have 30,000 students. So they could say, hey, we signed up 30,000 students. But if those students aren't actively using the platform, they're not generating revenue from it. So yeah, they could have, 1 million users, but if only 40,000 of them are generating your revenue, your average revenue per user is going to be a crap number. So I'd be more focused on acquisition costs, and I'd be more focused on revenue per user than just the total user number. But it's good to have, obviously, the bigger pool you have, the more likelihood you have of generating revenue. But I have seen that shift. That's why I kind of started in when I started my talk about the shifts from 2020 to 21. I mean, I got really weird looks from people when I asked about profitability and revenue growth. And now unprompted, people are like, here's where we are with revenue, here's where we're going to be break even, because I think that's kind of even what you saw with Silicon Valley Bank and why they went out of business, because you had all these venture companies that were losing money. They stopped raising money, and then they pulled all their money out of the bank because they needed to spend their money to stay afloat, right? It was a simple problem that happened, and they were just sector focused. But I think that's kind of the changing trend in venture, and starting to see it a lot more, especially with a lot of the East Coast firms, is they're getting more focused on the revenue metrics than they are just top line growth, top line user growth.
I don't know if you saw, but speaking of, speaking of Disney, I saw today that they announced that they're raising rates on streaming.
Yeah, I think they have to. I think they've made a strategic mistake. I follow it closely because I can see the Magic Kingdom fireworks from our house. I live like 10 minutes away from Magic Kingdom. So a lot of the people we know around here work for Disney on the executive side. So I always follow it closely, and the Orlando papers cover it pretty heavily. But one of their biggest flaws is that Disney wanted to acquire back all their content. When everybody went streaming, Netflix had everything for a while, right? They had The Office, they had all the hit TV shows. And then everybody turned around and said, wait a second, we can't launch Peacock without The Office. We got to go get it back. So Disney said that about all their movies. They said, wait a second, we can't launch Disney Plus without Pirates of the Caribbean and all these different titles. Beauty and the Beast. We can't have Netflix with Beauty and the Beast and somebody's paying for Disney Plus. So they paid to get all that content back on their platform. And the returns they've gotten from that content haven't been great, right? So they paid, a fortune for Beauty and the Beast to come back, and they're only getting so many views on Beauty and the Beast. And so it didn't really work out for them, right? There wasn't that big of an audience who joined Disney Plus just for Beauty and the Beast. And they lost money because they spent all this money with this rush to get out of these contracts and buy back their content. They actually took a $2.5 billion charge on this earnings report related to reacquiring content and licensing. So yeah, I think the whole streaming thing is going to be interesting. I know we were just making a decision, were we going to get cable? And we're like, no, we won't get cable. I spend way more than I would if I just had cable. I have Fubo TV, I have Disney Plus, I have Paramount Plus, I have Hulu. We have like 17 different subscriptions. It's like the opposite of what happened. With cable, you got everything and paid one price. Now I pay a million different prices, and I'm not even sure what I have, and half the stuff I don't even use. It's crazy, the whole streaming thing. I'm wondering when there's going to be a massive consolidation there too.
Just an additional question on the revenue per user. Is there a magic number or a magic percentage that you look for?
No, not really. I mean, just something that honestly is more than the acquisition cost per user, right? I mean, that's and another thing to add on the user, just thinking about those other companies and the user-focused investors questions that they ask is daily active users and monthly active users. They want to see how active those users are too, not just, how many people are logging on monthly, how many people are logging on daily, not just the total number of users. But no, there's not really. I mean, if you want like a gold standard in numbers, you could look at Facebook's earnings report. They still disclose how much they make per user, and they're pretty much the high end of that. So, that could be like hey, if you get to the X number of revenue dollars per user, you're golden. So I think that, that's kind of the benchmark. So if you're below that, I mean, it's fine, but that's probably the high side if you're looking for a metric.
Thank you.
I have a question. You mentioned debt and maybe private credit. We see a lot of discussions, some of these big firms like Apollo, etc., working more with insurance companies, trying to, I don't know if pivot is the right way, but kind of changing strategy, looking more private credit or collaborating with different insurance companies. Berkshire Hathaway is a good example of that, because they have this long-term cash management capabilities. So how do you view that market, or you collaborate with some of these players?
So we're not so much focused on the debt side because we're an equity venture investor, and most of the companies that we'll work with are getting the private bank lines of credit that are just really revolving credit facilities just to fund operations. And, you know, when they have a lag on invoice payments like VATN or Zero Rise, they work heavily with the government, the Navy and the Air Force respectively. So for them, the Department of Defense could pay an invoice in 90 days, it could pay in 120 days, but they're not really that upfront about when they're going to pay the invoices. So for the companies in our portfolio, those credit facilities help them bridge the gap between providing services and actually getting paid. As far as the private credit space, yeah, I have seen a lot of the bigger private equity players, KKR and Moelis, et cetera, are tapping into insurance because they have so much cash on hand to try and basically borrow alternative money instead of borrowing it from banks. They're trying to borrow it and just sort of set up all sorts of different structured credit facilities because money's so much more expensive. I mean, I think I don't know what the Wall Street Journal prime rate is, but it's like, I think it's 8.5 now. I mean, I know people who used to, actually, I had investors who would invest off of, you know, they would borrow against their equity portfolios to invest. And when interest rates were 2-3%, it made sense, right? I mean, they were super liquid. They could buy treasury bills or any security, and they could get, you know, 60%, borrow 60% against that security, and the dividend payments alone would cover the interest on their line. So they'd invest in venture and keep liquidity.
Lombard lending, many of private banking clients do that or did that. Yeah.
Yeah. And now it's just not a feasible alternative. We looked at buying our house that way when we were going to buy a house 2 years ago, and it was like the rate I was getting from RBC was like 3%. And it was like, oh, this is great. I'll buy treasury bills that are yielding, you know, or municipal bonds that are yielding 5%. I'll make money borrowing money against myself. And now, I mean, you can't do that anymore. The rates are like 8-10%. I mean, you have to. You're borrowing money now because you need it. It's no longer an investment strategy. So that's taking some liquidity out of the private market space as well. But I think when a lot, like I said it briefly earlier, but when people think about the slowdown in funding and getting these exits, it's because these funds can't raise money like they used to because they're not returning capital to LP. The IPO market's been shot. The big merger market's been shot. So these companies aren't getting bought. These LPs aren't getting money back. So these LPs are reluctant to reinvest in these big funds because they're not getting any capital return to them. I talked to a guy 2 weeks ago. He told me he was in 30 private equity funds. He said he has not gotten a dollar back from any of them in the last 18 months. I mean, 30 funds, not one single exit, not one single distribution. I mean, that's tough from a liquidity perspective.
Yeah, this is a genuine opportunity for the right group, because as a small business, when you're between 2 million and 10 million of revenue, the available cash for you to borrow is predatory. I've paid as much as 38 cents on the dollar to get cash flow. You know, so there's a genuine market space that's available there for the 2 million small businesses that need it. Right, because the banking system is just not available for them until they hit, you know, 10 million plus revenues.
Yeah, I agree with you 100%. I work with another group called Dealmaker Wealth Society. They teach people how to buy businesses, and they're a bona fide group out there. They got like 600 members, and they're probably closing about 50 deals a quarter. So they have, of their 600 members, a third of them are closing deals, which is really great. And one of the things we're trying to help them with is two things. One is these people are borrowing from the SBA mostly and getting down payments from the SBA. They're trying to put 10 to 20% down. So they're looking for between 200K and $1 million. And that's a really tough amount of money to raise. I told them, I said, most funds will not invest at that size in the private equity space. It's too small. And then, you know, there's another deal that they were thinking about financing themselves. They were buying a company for like $5 million. And they're trying to get a debt check between, as you were saying, 2 and 10 million. And I set them up with a couple of different acquisition finance guys, you know, the $10 million minimum, $10 million minimum. And then there's guys under $1 million who will do like smaller checks. But yeah, that 2 to 10 space is a death valley in debt capital markets.
Yeah, it's
There's
really
nobody
tough.
doing it.
It's cheaper for me to factor government invoices from our client base than it is for me to borrow money, you know, anywhere.
Yeah, and I mean, like I said, you borrow at 38%. I've seen some of the factors on some of the term sheets they've gotten. It's 38%, it's 42%. I mean, you borrow like that because you have to, not to grow your business. I mean, that's not even really a strategy. It's just, that's what you have to do.
It kills all the profit.
Yeah, you're taking all the cash flow just to service debt. There's no, what's your benefit? Now you're stressing just to pay your debt. You're not getting any benefit.
Yeah. So there's that.
So next question, just feel free to chime in with your questions.
Well, I have a quick question. You mentioned ed tech. Does your firm ever consider investing in ed tech firms?
Yeah, we have an investment in a company. I actually was alluding to it before in the first fund called Yellowdick. They're based in Philadelphia. They're an ed tech provider.
Okay.
So we did do that. Yeah, they fit our criteria perfect. We really like the management team, and they've performed really, really well for us. So yeah, we will consider, like I said, we will consider things outside the security space. It's just when I'm out looking, if I'm going to conferences out there sourcing deals, I'm mostly sourcing in that security space. But from time to time, I have a webinar software company that somebody sent to me that's really, really interesting that we're taking a good look at right now. But yes, we will look at other stuff. I never want to be a fund that pigeonholes away from specific deals just because of the sector we're in. I want to invest in the best founders and the best companies, irrespective of industry. With that being said, having some focus, because I can help those companies in the defense space get further along, where in the ed tech space, my resources are rather limited because it's just not a space I know a lot of the players in.
Yeah, and I guess conceivably there could be overlap at some point. I mean, there's a lot of training needs in the defense sector.
Yeah. There's a million different companies out there that are making a fortune right now, because most of the government agencies are outsourced, aside from the Army, but even a lot of their training programs are outsourced, especially for the CIA, FBI. There's people who are teaching those programs, and they're paying the government's paying a fortune for those people to get trained. So yeah, there's a ton of training and education going on right now in those markets.
Great, thanks.
Hi, Kyle. I have a question. Our product crosses over into the VA and VHA have asked us to apply to be an electronic cognitive device as we help people with PTSD, traumatic brain injury, and such. So it's a great interest both on the rehab side and also the aging in place veterans. But John and I have been spending a couple of months trying to find an established vendor to the VA, VHA, because we don't want to have that steep learning curve and give them our product line and support them. I just want to, if you knew anybody, I'd like to follow up afterwards or be able to point me at.
Yeah, we know a lot of companies that have actually gotten VA grant funding. So we do know a lot of companies in that space. And I don't know if I have a contact, but I know some of our portfolio companies definitely do have good contacts into that market.
That's fantastic. Yeah, I'll follow up. Thank you.
So next question.
Yeah, I just had Kyle, I just had a quick question about profitability. I think you mentioned that Backswing is primarily an early stage venture fund, and profitability is a focus point for you. And of course, many, as we know, like kind of earlier stage companies, as they're getting their traction, as they're building out their product, sometimes profitability can be a tough, challenging thing to achieve. So I'm just curious to hear how you think about profitability from your seat, and like what that like runway to profitability looks like in your head.
Sure, yeah. So I think that most of the companies we invest in have been around for 12 to 18 months because they have a product, they have revenue. They usually have $1 million. I mean, not all. Again, I'm not a dictator. I don't have a strict threshold that if you're at $900,000, we won't do it. What we'll typically say is we like to see at least 1 month of ARR above or MRR above 100K. So that's kind of like what we'll do if somebody's not at $1 million in booked revenue yet. So yeah, I think they're with that being said, 12 to 18 months along, we'll think about a company that has a year, so you think about a company, they've been around 12 to 18 months, they've been operating, and then we're investing, kind of takes us a little bit of a time to get an investment in. So you call it 2 years, right? We invest at a company's 2-year anniversary. So by 3 to 3.5 years, 12 to 18 months, we want that company to be profitable. And I think that's a reasonable timeline in the venture space for a company to be profitable in 3 to 3.5 years of operation. Because ultimately, you want them to sell 5 years from inception, because I don't really make any money until companies sell. So I'm very focused on getting companies exits. I mean, that's my job, is to return as much capital to my investors as I can and nothing else. So that's kind of how I think about profitability in the life cycle of these companies.
Can I piggyback on that question? It's like, so as I mentioned earlier, we're still on the front side without actual users, but we're backstopped by a service business, right? So we're doing we'll very likely hit a $3 million revenue mark this year. And so I'm just wondering, does that play into your thinking if it's backed up by a real business model that is supportive and can convert its client base?
Well, potentially. I think it depends on the dynamics of the entity relationship and the investment, because you're an investor, the worst case scenario for an investor. So you invest money in a company, the company runs out of money because they're unprofitable or any other host of reasons, right? That's the worst case scenario. So invest in someone and they run out of money. So I guess it would really depend on the mechanics and the dynamics, right? Is there a guarantee that you're going to continue funding? Because if we write a 500K check, we run through the 500K and we say, you know what, this isn't going our way. We just want to focus on the service business, and there's no, they're not part of the same entity. Now we get to a point where it's like, well, shit, if he's not going to fund this company anymore, we either have to put more money in a losing business, which we don't want to do, or hope that he decides to continue to fund it. So it depends. I've seen situations like that. There's a company we've looked at in Florida where they have a parent that's very successful. And then, they're doing a lot of kind of reinvestment into their, call it subsidiary companies that they're spinning off. And that model kind of works. But the honest answer is it just kind of depends on the relationship and what type of agreements there are between the companies. But yeah, there's a company we looked at and we got comfortable with that financing structure. We just didn't end up liking the company that much. One of our problems with them is they had so many spinoffs that the core company was great. The spinoffs probably are going to do great too, but we had one that we initially passed on. It was in cybersecurity. We didn't love it. Then they had another materials business that we were like, we kind of like this. And then we're talking to the guy who was running. He's like, well, if this one's not successful, this one will be, or this one will be, or this one will be. And I was like, you're right, but you own the whole pot. I'm only going to invest in one deal. Maybe I'll do another one with you if this one's successful at some point, but I'm only picking one. So I have to pick right out of all your deals, where in your mind, you just need one of these companies to be a really big success. And you're going to be like, hey, this one failed, but you should have invested in this one. And I was like, that doesn't work for me and my investors. So we got comfortable with the financing, just didn't like the deal. So the answer is yes.
Very cool.
We have a latecomer, Andrew Bain, who just joined. Andrew, do you want to introduce yourself? We always give everyone the opportunity.
Sure. I appreciate that opportunity, and I'm just popping in for a few minutes because I only had a little window to participate today. But I'm a friend of Joseph Katz. I knew you guys were doing this, and I wanted to get a chance to say hello. I run a company called Brand Intros, which is responsible for marketing storytelling on behalf of numerous consumer brands.
Oh, thank you.
Awesome. Well, thank you for joining.
Thanks.
So
Do you have any
Carol,
questions I can answer?
Yes.
If you don't mind, I'll just listen in for a bit. What
Sure.
are you up to?
We've just been talking about the broader economy and venture funding, specifically at the seed stage. I run 2 seed stage venture funds.
Well,
I have a question. Go ahead, Andrew.
No, go ahead, please.
So, I noticed that, some technologies or some verticals you're more comfortable with than others. What makes you, what are you comfortable with? I know that, and you probably have LPs or associates who are also comfortable in certain areas. So just what would that focus be, or what would your sweet spots be, just out of curiosity?
Yeah, like I said, it's software and hardware, defense and security. I would say it's easier to tell people my hard nose are cannabis, crypto, and the life sciences, except for medical technology, non-regulated medical devices. I won't do cannabis because I have investors who have securities licenses and it's not technically legal and it's a giant headache for them. I won't do crypto because I'm not a huge fan of crypto outside of Bitcoin, which I'm a big fan of. And I won't do life sciences just because it takes way too long. There's so many regulatory approvals involved, and it's just, I don't understand the space well enough to do anything that needs that type of approval or that type of approval process. And we also don't have a big enough bankroll to fund those types of companies because they go through millions and millions of dollars and they just don't fit our economic model either. So those are the things that I absolutely would not consider. But outside of that, we pretty much look at everything else.
Okay, thank you. So Yusuf has a question.
Yeah. So just wanted to ask, on a more like founder level, what are some of the things that you also look at? Experiences in the industry, or like, or this is a more general industry trend at the moment question I'm asking, I guess, but would VC at the moment invest in founders, who are quote unquote super smart, if you may, but may not have the experience to possibly take the company, from 0 to 1, just want to understand the founder dynamics behind investments at the moment.
Sure, really good question. So one of the reasons we focus on the defense and security space is we love investing in veteran-owned businesses. They tend to be very mission-oriented and very good operators. So that's one of the characteristics we look for, somebody we think is going to be a strong leader. We do look at industry experience, right? I don't want somebody who's starting a software business who tells me, hey, I've been a doctor forever and I'm starting an AI company. That has nothing to do with medicine, because you want people who have some background that logically lead you to believe that they will be successful in what they're doing. So that's another part of it, is you want to see a background, you want to see somebody who's a strong leader, and you want to see somebody who's a strong operator. Generally, CEOs, actually, in my experience, who are really good at raising money are not so great at running businesses, and vice versa. Ones who aren't so great at raising money tend to be really good operators, because that's what they're good at. They're not the salespeople. They're like the head honcho. They can run the show. They can delegate. They can get people to perform tasks. So we're looking for founders that have a background that would, give us an idea that they're going to be successful. We're looking for founders that we connect with. One thing I do before I invest in any company, doesn't matter the amount, I fly and go out and meet wherever the CEO is. I want to see where they work out of. I want to see their office. I want to meet people. I want to make sure you gel with people, because everybody on this call, I'm sure you've met people you love and some people you don't love so much. And you want to make sure you're investing in people that you're comfortable doing business with, and you want to talk to on a daily, monthly, weekly, annual basis. So those are kind of some of the criteria. But it honestly, for me, there's no like chart or specific criteria. It's generally just kind of like, hey, I connect with this person, I like this person, I believe in this person, or I don't. And that's kind of how I rate founders. It's got a lot of intuition and just kind of your feeling and how you interact with them.
That's a really interesting take, because like we made a conscious decision between getting certified as a veteran-owned versus a woman-owned business. So we're a woman-owned business, and I took a secondary position, own 49% of the company, and she owns 51% of the company, in order to leverage that, because 80% of our client base is government. And we
are you a veteran?
Yes.
Oh, thank you for your service. Yeah, I mean, that wouldn't like exclude it for me, right? I'm not looking for a designation. You're in an operator role. I mean, you said you own 49% of the business and you're a veteran. So to me, that's a veteran-owned company. You probably can only take one designation, one official designation. But yeah, to me, that would be a veteran operated business, right? It wouldn't just be, oh, this is just a woman-owned business. This is veteran operated. So
yeah, it's a really, because I mean, we went round and round, making that decision. And so the structure is really important. The other piece that we've been kind of struggling with, and maybe you have some insight here. Most venture funds want you to be a C Corp, when they're ready to invest. And so we've been operating as an S Corp and have made the commitment to convert all the documentation upon investment. But I'm wondering if we should just pull the trigger ahead of time to be more attractive and be able to have a wider variety of conversations, or if our approach, a little bit more conservative approach that we've taken is viable.
Yeah, I mean, investing in an LLC is definitely more of a pain, because you have to do share assignments, and then I have to wait for you to get a K1 to finish my tax return, which, by the way, that's one of the worst parts of running a fund. Is you get people who are like, on February 3rd, they're like, hey, do you have K1s ready yet? You're like, we gotta wait for 6 companies to get us a K1 before we can do anything. So I wouldn't say it's exclusionary, but I would say that most VCs like a C Corp. They're easier to acquire at the end of the day. It's easier to pay dividends through. You're not really ever flowing profits through to venture funds or doing rev shares with them. So that makes things tricky on an LLC basis because now they're getting a K1 and they own part of the business, but they're not getting profits. So it just complicates everything a little bit. So if you're definitely going to go out and you're going to raise money from venture, not just an individual investor or an angel investor, I would definitely recommend converting to a C Corp and being proactive.
And then one other piece, like we've been approached in multiple environments to participate in a bunch of, corporate programs. The two that are top of mind is EY has invited us to be in their entrepreneur program, and JP Morgan Chase is also kind of chasing us around the couch right now. And so, I'm just wondering, is that something that's attractive to see people in organizations and structured programming like that, or does that even matter?
I think the biggest benefit for you would be to get to the relationships. So there's an accelerator I've found a lot of deals out of in Austin, Texas called Capital Factory. They do a lot of stuff with veteran-owned businesses and the defense space. I'd encourage you to check them out. But I think it's more, hey, if you go into a JP Morgan or EY program, what funds do they work with? Who do they work with? Who can they open doors up to? More so than me seeing on your deck, hey, it's a JP Morgan partner company. I mean, the big one people love is Y Combinator, but I've never done a Y Combinator deal because the valuations to me are marked up in infinite amount of times. And I've also heard that before Y Combinator's demo day, the best companies in their cohorts actually aren't at demo day, and Y Combinator takes the whole rounds themselves. So I don't know how true that is or not, but I've heard that. So I think it would be, the biggest question to ask any of them before you did a program would be, what doors can you open for us, and how can you specifically help us? And then those things will help you more than, just having the certification or the check the box that you went through their program.
Got it. Thank you. Thank you for that.
Yeah, seemingly everybody except maybe banks at JP Morgan nowadays. I mean, they're gonna probably, with what they've done with SVB and First Republic, they're probably gonna get a ton of the venture banking client. They're gonna get a lot of venture fund clients. They probably already have a ton already. So JP Morgan is gonna have this whole massive network of
and we're getting a lot of attention because we're wholly Latino owned as well, and not, we're certified woman-owned, minority-owned, disadvantaged, all that stuff. We're in the final stage of our GSA listing, and so this kind of discussion is around positioning, right? And so I'm just wondering, like, the strongest markers that investors like you really like to see. I mean, obviously, you've already said profitability is really the bottom line, but I'm just wondering, in terms of positioning in the marketplace, are there flags? Are there things that you really want to see?
Yeah, I mean, honestly, for me, the biggest thing is just meeting with the founders and connecting with them, and just having people you're comfortable with. It's not any specific designation. I just want the companies that are going to perform the best and they're going to generate the most revenue and thus the greatest return for the fund.
I wanted to, as somebody who mentors at various accelerators and was an early mentor at ERA. ERA, when they accept a company, they assign them what they call a lead mentor, who is a subject matter expert and can open doors. And they're looking for cohorts for the next session too. So I wanted to mention it. It's a very important point, really. Andrea is technologically challenged, and she has a question in the chat. Thoughts on AI? To what extent are you actually investing into companies incorporating it, and at what level? Application, foundation, computer vision, etc.
Yeah, so I guess in this fund we have one really focused AI company, and that will OpenAI uses it. So I would say we are doing it. We're not looking at companies because they're specifically marketing themselves as AI, although that is definitely the hottest investment sector right now. If they had a hottest investment sector rating, it would have been crypto and blockchain for a while. Now it's AI. I mean, you can put AI, you look at these companies in their earnings reports, but well, we're using AI for what? Don't really know, but they're using it, and the stock prices go crazy. I mean, NVIDIA, because they make the graphics cards that go in most computing devices. I mean, their stock is just crazy. If you look at the fundamentals in their stock, their revenues are like, the stock price should be like $100. That'll come back at some point. But to what extent are we investing in companies with AI? So of the 3 companies we've invested in, 2 of, well, I guess all of them use it to some degree. I think as a technology company nowadays, all of them are using AI. All of them are using AI. It's some way, right? Zero Eyes is an AI gun detection platform. So they have an algorithm, right? They're training a camera over and over again to see different types of firearms and different types of weapons on people's body, backpack, and what they might look like. So that's a use of AI. That's an application of it. We've invested in them. BATN, their drones are remote controlled, right? So they're using some sort of AI and algorithms to pilot those drones. A use of AI. Neither one of Zero Eyes is marketed as an AI gun detection. VATN is not marketed as an AI-based company. OpenAI Analytics, they're using some artificial intelligence algorithms, right? ChatGPT just released one of their free features. They're using ChatGPT to sort through data and do some of the work that an analyst would. Instead of screening data in Excel or another data screening tool, they're using an AI application to screen their data. So again, they're not really marketed as an AI company, but they're using it. There's another company, 911 Smart Response. I did a demo about 2 months ago down at the Collier County, Florida, where Naples is, Emergency Operations Center. And one of the really cool things that this company was doing is they do AI transcription of radio communications, and they do keyword scanning. So they've developed an AI tool that can scan radio frequencies. So if you're in a dispatch center in Collier County or anywhere else in the country, there's all these calls coming in. There's a million different dispatchers. I mean, the dispatch floor looks like a trading floor on Wall Street like 20 years ago. I mean, there's people everywhere running around. So one of the things this tool has the ability to do is direct response resources. So, hey, we got officer down, shots fired, fire, whatever keywords that they're specifically looking for, they can direct responses, get resources there quicker, whether it's fire, EMS, or police, to save lives or make situations better. So they're using AI. So I see a lot of companies, and I think that, I think how many people on this call use Siri on a daily basis, or, you use calendar, you're using your iPhone, you slide down and it's giving you a hint of what to do. That's AI. So I think that there's a ton of AI applications out there, but I don't necessarily know that, the companies need to market themselves as an AI company. So I think, to answer the question all in, we're investing in companies that pretty much all of them are using AI to some degree, as most of us are in our day-to-day businesses. But I'm not exclusively doing that, or I'm not looking for companies that market that way.
I was just noticing that speaking of AI, that Stability AI is coming apart at the seams. And they raised a lot of money.
Yeah, I mean, some of these companies don't have like I said, an audience or a client base. I mean, they just raise money. I mean, I was saying this, that hits on my point before. Some of these people who are great at raising money are terrible terrible operators.
Right, but they had the right to come on to investors because it was AI, and they were early to AI.
Yeah, it's often, like I said, I'll go to some of these conferences. I don't go to a ton. I'm going to one, Fed Supernova in Austin. It's a really, really good defense conference. It's actually coming up in a couple of weeks. I'll be there. And like I said, pretty much any company that, the first they start in their pitch to me that we're in AI, machine learning, et cetera, they throw like 3 acronyms out there. And that's usually your red flag, that they really don't do anything. But they're giving you all these big technology. We're a big, you know how many companies I see, and in the deck, they're a big data, machine learning, AI driven business. That's like, I invest in these things, and I could broadly define machine learning and artificial intelligence. And I mean, big data is such a just absurd word, right? Because what does that actually even mean? So yeah, I mean, that's typically my red flag. When companies come at me with that, I'm right away I'm running for the hills. I'm saying, oh, this is too much.
I know, but for a lot of investors, that's an aphrodisiac, those little catchphrases, and we know that. But not all investors are experienced investors, so always be careful, founders. Next question, I'm sorry.
Kyle, can you say who your limited partners are? What's their background?
The bulk of my limited partners are family offices, funded funds, or high net worth individuals. I don't go into like specifically who my limited partners are for a lot of different reasons, but that's the makeup of them.
Okay, great, thanks.
Yeah.
So next question, feel free to ask your questions.
This is a little off topic, but Kyle, what made you decide to relocate to Florida recently?
Well, we worked our way down the East Coast. I could tell you, we were in New Jersey in 2020. It was March of 2020. They closed all the golf courses, and as you, Bonnie, pointed out, based on the name, I'm a big golfer. They closed golf courses, and I'm like, this is crazy. Closing golf course, I can't go outside and play golf. I'm leaving New Jersey. I'm done. We had a house up there. We packed the car. They closed the golf course on a Monday. I think on a Thursday, we were in North Carolina. Golf courses were open in North Carolina. We Airbnb'd a place in North Carolina for a couple of months. Liked it, didn't love it. The weather wasn't as warm as we'd liked it to be in like the winter. It's really hot in the summer. It's not, for my business, being in an environment where there's a lot of high net worth individuals and financial service companies is important. Wilmington, North Carolina is certainly not that. So then we actually were like, you know what? We don't know where we're going to go. We had this trip. We're like, let's just go to the Bahamas. We went to the Abacos, and we were out there. We had our dog with us. Our dog's a service dog. We had her with us, and we were like, you know what? We ended up staying there for 2 months. We were like, we're going to move here. And then there was a day I was like I was actually funding a deal. I was on the beach, and I was like, this was in March of 2021. I was funding a deal. I sent an email to confirm a wire to our bank. Said, hey, I need this to get done. And then they started calling me and emailing me. Couldn't get anything. I go like to where we were staying. It's like a private club, so like they have like a main bar restaurant. I go to the person, and I'm like, I was like, can I use your phone? And they're like, sure. And they're like, it's dead. And they're like, oh, okay. And I was like, your phone and internet's down. And they're like, yeah. And do you have a problem with that? And I was like, well, when is it going to be back? They're like, I don't know, sometimes hours, sometimes days, sometimes a couple of weeks. And I was like, oh my God. So I went to my wife and I was like, we can't live here. I was like, as much as it's nice and beautiful and everything, I was like, I can't not have phone service for a week. I was like, people are going to think I vanished off the planet. So we got on like the next flight to Florida. We rented a place in Orlando. We stayed in a place we rented for like 2 years, and we closed on this house July 14th. And I've been in this house for a little less than a month now, doing work like crazy. So we've been in Orlando since about May of 2021. So it was weather impacted. I'm a golfer. I like the warm weather. I hate the cold. I hate anything under 60 degrees. And I don't like paying state income tax, or really any tax for that matter. But you can't really avoid the federal thing.
Where in New Jersey were you from?
Livingston.
Okay, yeah. I'm exit 3, so Turnpike. So
you're down there a little bit. You're south coast, like Cherry Hill.
Yeah, a suburb of Philadelphia. Our son just recently relocated to Florida, right outside of Gainesville, a few months back. So I'll be making trip. Surprisingly, Philadelphia to Orlando is pretty cheap air flights.
Well, Orlando, American flies at $1 million times a day. That's the one complaint about Orlando Airport is if you're a frequent flyer and you're picky about your airlines, the only hubs in Orlando are Spirit and Frontier. So American has a couple flights everywhere. United has a couple flights everywhere. Delta has a couple flights everywhere. Southwest has a couple flights everywhere, but it's not a hub for any of them. So you're either flying a different airline every time, or you're riding with the big yellow bus or Frontier. So it's not ideal for business travelers. It's ideal for everybody getting here. I was like, to me, like every major city has direct flight to Las Vegas. Well, there's like no direct flights from Orlando to Las Vegas because they're both destination cities and everyone's coming here from conferences. Everyone's got one flight there. But between the two cities, there's like nothing, because who goes from Orlando to Las Vegas other than people who live there or like avid conference goers?
Yeah, that's the problem we have is he's like an hour and a half north of Orlando. So you got to fly to Orlando and then drive or someone pick you up. But if you take a commuter from Orlando to Gainesville, it's really expensive.
Yeah. Is he in Ocala?
No, he's Newberry. It is the area where he's at. He's like 10 minutes out to the west of Gainesville.
Okay. Yeah, they're building an airport, at least they're rumored to be building an airport kind of in between Gainesville and Orlando, right by where the villages is, because the population's grown so much. But again, it's not like they're not going to have international flights or flights from New York or Philly. You're still going to have to come to probably Orlando or Atlanta.
Yeah. All right. Well, thanks for that info. I appreciate it.
Yeah.
Next question. Ian, I know you always have a question, and don't be shy.
I'll go back to our company. So we're not selling to consumers yet. Our current business model is we are partnering with universities and colleges, mostly in Asia, now in Africa, soon in the US. And hopefully we'll be selling direct to consumer soon, but there's some reasons why we decided not to do that right now. Well, what do you think of that model? I mean, is that more appealing to you than a direct to consumer model? It's cash, it's a cash business.
Honestly, I like businesses that I don't really have so much of a preference there, because I think both B2B and B2C both have their pros and cons. I just like companies that make money. Honestly, I know there's some funds that are actually have that focus, right? They'll only do B2B or they'll only do B2C. And I understand some of those reasons why, but I'm not such a big like, hey, you have to be B2B, you have to be B2C. That's not really my thing. I like companies that make money, they're going to grow and be profitable. I don't necessarily get too caught up because we've invested in both sides.
Right, and then, well, to follow it, do you like companies that keep things simple, to follow a single plan, or to try several different things at once?
No, I like companies that keep things simple. I always use the example of Apple. I said, right, Apple is the biggest phone manufacturer in the world. They're probably one of the biggest service companies. They do the AirPods, they do this, they do that. But what did Apple start with? They started with one computer, the iMac. They didn't have laptops, they didn't have iPads, and then they do one product at a time, right? Apple never goes out and rolls out 5 different products. They roll out one product, some software updates, and I guess the iPhone, it's not really a new product, it's just a continued development. But every year they roll out one new product, and they do it really, really well, typically. I mean, I can't think of a big Apple flop. If they had a flop, they fixed it pretty quick, but yeah, I like company. I use that model. That Apple was a computer company, and they're a laptop company, and they're a software company, and then they just kind of stepped up the stairs on doing different things. I see a lot of companies that do that, and one of our portfolio companies is just counseling them against that, because they're like, well, we could sell to government, we could sell to corporates, we could sell to local government, we could sell to all these different angles. And I said, just focus on one in your deck, because somebody wants to see you capture one before you're going all over the place. You're going to need different salespeople, different sales teams, different collateral, different different case studies. You're going to need different everything to sell to all the different markets. So just hit one market and hit it really good.
Got it. Yeah, thanks.
And Apple's having a little problem with their VR headsets these days.
Are they?
It's a long-term thing.
Are the headsets out yet?
Well, they're supposed to be. Go ahead, Ian.
No, I'm just saying that they're being sold right now mainly to developers, not to consumers. So that's fine with that.
Yeah, they couldn't have the large scale rollout they were planning because of problems with the manufacturing.
Yeah, it'll take 5 years.
I don't know if they'll ever do the card thing either. I'd be really curious to see if they ever get into the card business.
Yeah, I don't see them doing that. I just don't. So next question or comment.
Do you have appetite?
I want to say thank you. I'm going to excuse myself.
Yeah, thank you, Daniel. Nice to meet you. Nice talking to you. Thanks for joining. And thanks for the question.
Oh, sorry, Zevin. Thank you, Daniel.
Thank you. So I was saying, do you have appetite for international companies? If so, maybe which countries would you be more open?
Yeah, so typically we'll do anything in Europe. I've never done a deal in Africa. I've never done a deal in Asia. But typically Middle East, Canada, South America, and Europe, yeah, we'll absolutely look at transactions in those countries. We try and stay around countries with similar laws and regulatory climate as same as the US, so we can understand it. Like I wouldn't do a deal in China, or Russia, because I legally don't think you could right now. But a lot of the countries in Africa don't have the built-up regulatory framework, and even honestly, if I'm out of turn and they do, I just don't really know it or understand it, so I'd be uncomfortable. But I'm very comfortable in Europe. One of our Fund 1 portfolio companies is based in Israel, so I love Israeli technology. I actually think it's some of the best.
Okay, good. Thank you.
Huge fan here too. Israeli tech.
What's that?
Huge fan of the Israeli tech.
Yeah, I think that the Israeli technology is far and away better than American technology. I think there's American companies that are better at commercializing some of the tech, but if you want a cybersecurity program or some of the security technology, we look at a ton of Israeli technology. It is fantastic. And their regulatory requirement allows them to develop things and get them to market much quicker.
Yeah, they have a lot of, when it comes to military and security related tech, is probably top of the line there.
Absolutely.
I've worked with a bunch of those founders over the years, and their biggest challenge, I believe, is getting into the U.S. market, because they don't have the they don't have the networks, and they don't have the understanding of how to bring those products here. That's
interesting,
usually
because every time I talk to a VC, it's like if they work in Middle East, Israel is the country that they're most open. So in my mind, almost it's like US, UK, Canada, and Israel. It's usually happening,
Well,
and then maybe some places in Europe.
I think that they're, some of the closest allies of the U.S. politically and from a military perspective. So I think that's part of it. And I think that, the way they do business is similar to a degree than they do to how they do it in America. And, and honestly, I know there's a lot of technology development in Dubai specifically, but I've never really heard of many deals and outside of energy in like Saudi Arabia and Jordan and Qatar. So I don't know how much development is going on there. I'm sure there is stuff. I'm just not that plugged into those markets. Aside from Israel, the only country I've been to in the Mideast is Arab Emirates and Dubai. So.
Yeah, on that point, I think the Abraham Accords are going to change a lot of that. With the Israel and Dubai and Emirates, you're going to start seeing a lot more development, I think, coming out of there.
Mm-hmm.
Well, there's certainly a lot of money being invested from Dubai and the Emirates and into tech.
Yeah, I think one of the craziest things I haven't been to Dubai since 2018, so maybe it's changed. But when I was in Dubai, pretty much nobody in Dubai is actually from the UAE. Very small percent. It's all expats from around the world. It's Americans. It's people from all over Europe, all over the UK, people from Asia, India, Australia. It's like a melting pot. Kind of similar to New York. It's a melting pot of different cultures in Dubai. It's very wealthy and well-to-do, but there was not a lot of people from UAE who I had interacted with who were actually born there and raised there. It was people from all over.
And when you mention tech, like of course it's a very general word, and yes, military or defense was mentioned. Is there any segment that you feel close?
No, we'll be pretty broad in defense and security technology, cybersecurity, weapon systems, surveillance systems, data systems, detection systems, monitoring, a lot of drone technology. I wouldn't invest in a drone manufacturer or somebody who manufactures drones, but I've looked at a ton of drone infrastructure players, software players. We looked at a really cool company out of Israel called Strix Drones that have like these drone docking bases. So think of it as like a iPhone docking station for a drone. So these things land on them in charge and they're right on the border, so they can go, respond as needed, and they don't need to take off, and they can just take off vertically and launch from the charging station. So they're always ready to go. So things like that we would consider investing in. Investing in a drone is kind of like investing in a car. It's such a big race and there's so much money being thrown at it that wouldn't be my preferred option.
What about robotics? I'm just curious.
Yeah, a lot of companies we look at use robotics. Again, a lot of these robotics companies early stages, they just don't make money. Their lead times to revenue are so long, and their valuations get so high before they get pre-revenue because they have to do so much development that they're just financially not a fit for us.
Okay. Next question. Or comment.
I'll ask another one. So, Kyle, what are some big risks that you see in the near future, the next 6 months for this sector?
For the defense technology sector?
Yeah, and for VC, let's say.
I'll go VC because one of the reasons why I do invest in defense tech is because there's a never-ending amount of conflict and potential conflict globally, right? You have the whole situation in Ukraine. You have another government was just overthrown in Africa last week. You have this pending situation in Taiwan. You have the border situation, which for surveillance and detection technology, depending on who the next administration is and what Congress is, could be a huge financial opportunity for some of the companies that we're working with. if they're going to spend significant capital on the border to try and secure that. So that's, there's so much opportunity, not to mention all the clandestine military operations the US does around the globe that just really aren't reported on. So there's never really a shortage on that side. So that's one of the reasons why I like it. I think that I'm really interested to see what the Federal Reserve does with interest rates. If they start to pause and interest rates start to come down, then I think that'll bring people away from, if you're going to be an IPO investor right now, you look at T-bills, you can make 5-6% on treasury bills, or you go invest in equities and your money could go up or down. Treasury bills are pretty much guaranteed. So I think once interest rates start to top off, and at least we see the Fed says, not necessarily go down even, but the Fed says, hey, we've reached the peak, we're not hiking anymore, then I think that'll be more of a risk-on investment cycle, because people will be preparing for the next part of this economic cycle, and they'll start to say, hey, it's risk-on again. We have to invest in IPOs. We have to do M&A. We have to take risks. Interest rates are going to come down. We'll take this debt right now. It's expensive, but we can refinance this debt. So I think that's kind of what I'm looking forward to in the next 6 months. I know there's been some rosier pictures about where we are with the economy, but I am actually generally pretty concerned about the broader economy. Outside of the top 20 companies in the S&P 500, the S&P 500 is generally flat this year. So there's a lot of companies that are losing value. Only about 20, and most of them happen to be these big tech companies, Microsoft, Apple, that are focused on this AI theme, that have seen significant gains in the market this year. I think the unemployment data is really disheartening. I know the unemployment rate top line keeps going down, but the workforce participation is kind of at an all-time low. If you talk to businesses, skilled and unskilled, all of them are having. I just had somebody here filing my house, which I would consider, partially more of a trade skill. They can't find workers. I talk to, investment banks and technology companies I work with. Their biggest problem is finding workers. So there's still a shortage of talent, and the labor pool is getting smaller, according to the federal data. And if you look at the unemployment reports, one of the things that you're seeing is a huge uptick in part-time employment, right? A lot of people are losing their primary job, or they're leaving full-time employment. They're taking multiple part-time jobs because that's the only thing they can do. So I have some concerns about, that. I have some concerns about the housing market, not so much home values. I have a concern about affordability, because, you look at buying a house now, the average home price in the US is like 500 grand. If you're someone who makes $60,000 or $75,000 a year, which I think 75 is still higher than the US wage household income, how are you going to save $100,000 to put down a 20% down payment? You're probably not. So you're going to have to go with a program like FHA, and you're going to have a monthly payment that's going to eat up most of your income. So people are resigned to renting for really long periods of time. And, for the average American, the biggest path to economic prosperity and growth is homeownership, and a lot of people can't afford that really at any level anymore. So that's what I think. There's trouble in the housing market. There's trouble in the employment market. And a lot of it is, due to rising interest rates, and so I think once things pause on the interest rate front, we'll get a better picture of where we are as economy. But so again, another data point is credit card balances for across the US crept above $1 trillion. That was a data point that came out this week. So there's a lot of, kind of, I'll call them at least yellow flags, but potential red flags to me in the economy. A lot of people gauge the economy based solely on the price of the stock, the Dow or S&P 500, which is up, but it's driven by its, top cohort of performers. A lot of companies that are down. So I'm hoping, I'm optimistic that in the next, call it between now and the first quarter of 24, interest rates come down and there starts to be more M&A activity, and, people are getting exits, and the venture ecosystem gets pumped up a little bit more and gets going a little bit more at the later stages, and really all stages, although I said seed is unaffected. And I'm hoping that the broader economy, interest rates come down, more people can get into houses, and the unemployment situation kind of evens itself out. The debt situation does it. There's a base case for that, a best case, and a worst case. So we'll see what happens.
So the interest rates are the key, basically.
I think interest rates are key. Yeah, I think they're key. I'm not so much in the labor force thing. I don't really know what to make it out. Labor force expert, but I know that data does concern me. But yeah, as far as the housing market and a lot of other parts of the market and the venture ecosystem, I think interest rates are the key. Yeah.
Thank you.
We have time for one or two more questions. If anybody would like to take this opportunity. Otherwise, I'm going to ask Kyle to leave us with some sage words of advice or caveats.
Yeah, I'd say no. I'd say
Apart.
look at all the data you can find if you want to see what's going on in the economy and watch the interest rates. I think the biggest inflection point we're going to see is when the Fed comes out and says, "Hey, we're done hiking interest rates." But I appreciate everybody coming out on a Thursday morning in August and listening to me talk and interacting and answering questions. So if you have any questions for me, please feel free to reach out. My email is on my website, backswingventures.com. It's Kyle@backswingventures.com. So if you have anything, you have a deal you want any input on, you want me to take a look at, happy to do so. Again, thanks for joining and thanks for the questions. I really appreciate it.
Thanks for your time.
Thank you. Are you open to dispensing advice to early stage founders as well, or are you too busy? Just asking.
No. I'm trying to think of what would be the best advice. I'd say focus on your product. Build a quality product, build a quality team, and focus on how you're going to get that to market and generate revenue. Right. I think it's a simple plan. Have good materials, have a good team behind you to market it and brand it, and have a good pitch deck, and have all the things. Because one thing I get asked a lot by people who are pre-revenue or really early stage is, what can I do? I don't have any money. Well, things you can do. You can get your entity set up, you can get your operating agreement set up, you can get a really good pitch deck done for not that much money. And if you don't have the money to even get a pitch deck done, then you got to look in the mirror and figure out if starting a business is for you, because there's a lot of questions at that point. And you can get as much as you can get your team and your product together. Identify who's going to be on your team, identify what your product's going to be, and develop it as far as you can without the capital you need, and then go to market and raise capital. So that would be my advice for early stage companies. And don't get discouraged, because I think that 90% of deals that come out to the market get funded. It's just a matter of how long it takes. Some take a week, some take 6 months to a year. So that would be my advice.
I'm just posting something in the chat, since I help founders with their pitch decks and their talking points with my partner, Deborah, who's also here. I thank you so much. You have a few extra minutes to get to the golf course now. Please say hello to your wife.
Yeah. Thank you. Thanks for having me. Everybody have a great week, great weekend.
Cheers.
Thank you. Have a good day, everybody, and see you in 2 weeks. Bye. Thanks, everyone.